So with that, let's move on to Q&A, which is live for those of you here in the room, and listen only for our webcast participants. But maybe there's a mic. Do you need this microphone back or not? You're okay.
Paddy, you've got a sizable bank loan portfolio. I was wondering if you just maybe talk a bit about that. Any thoughts you've got on that market, how it's performing, and presumably you're seeing quite a significant increase in income from that portfolio given the LIBOR linkage.
Yes, I mean, not a considerable inflow, but your point is well made that once we get above the LIBOR floors, we do have a very positive correlation to LIBOR rising in terms of our cash flow, assuming all other things are equal, i.e. there is no other effect on defaults or anything else. I don't know, it depends how detailed we want to get. I mean, maybe Reid, do you want to talk a bit about?
Sure. So I think interesting, bank loans that we have investments in are really through our investments in CLOs. And that means that, and you're right, we do have them as floating rate structures. So when LIBOR goes up, it does help returns as long as defaults don't increase at the same time that interest rates are increasing. Our view at this point of the cycle is we're probably beyond the midpoint of the cycle. Now, that's probably not a bold statement to make. But if you think that you're in the past the middle, then you need to start thinking very much more about defaults and playing defense, particularly when you're invested in CLO structures, that we are big believers in that as a good way to get bank loan exposure to hold your investments. And what CLOs allow you to do is it gives you liabilities that are locked in for more than 10 years when you're holding an asset that tends to have, as a bank loan, an average duration of maybe 3 to 4 years. So you've got locked in financing for assets. If you can manage your defaults low, and if you're right, you're beyond the midpoint of the cycle, then if the world gets worse, as long as it doesn't get so bad that your defaults go high, if you can manage your defaults and the world gets worse, you'll have the opportunity to reinvest those cash flows in those structures at wider spreads, which will actually enable you to make more return in that environment. So at this stage in the cycle, we believe it's time to focus on cautious managers, managers with proven track records of low defaults like LCM, and to work with them to create portfolios that can achieve a nice return now. This is not the time to try to knock the cover off the ball by adding a lot of risk into those portfolios. But by letting that structure work for you, if you're right, and if things do get a bit worse, it's nice to have some things in your portfolio that can actually make more money, and you've got your financing locked in a way that you may not be able to finance at that point in time. So that's how we have our exposure structured. That's why it's structured that way. And that's why we like that exposure, particularly with a defensive manager like LCM and other managers beyond LCM that also have a defensive profile.
Maybe Yuko said maybe the red one.
Yeah, thank you. That better, yeah. I was looking at your impressive growth in net assets over the years. And if net asset growth is on a per share basis is often a function of how you value those assets. And when I look at the LCM deal, which you did, which you clearly, I know you did it with the benefit of hindsight, with great foresight, but you did it incredibly well. You paid very little and bought an asset manager, which has grown enormously over the period. But that produced $150 million of your net asset growth. If I look at all your net assets that you have in fund management, how much of it is valued on the same basis? In other words, I don't know whether you have a sort of glass half full approach or glass half empty to the value of asset managers, because I mean they're either worth, in my opinion, sort of nothing or quite a lot. But that $500 million you have of your $2.5 billion in net assets, is that concern you? That's a bit opaque. How do you value it? And what's the range that you'd put on it if you were to give a view on the range of the value of that $500 million?
Sure. Well, I think a very important question. I'm going to call on Paul, our CFO, to talk in some detail about how they're valued, and then maybe he'll give you the, if you like, the quantitative, and then maybe I'll give a qualitative on top afterwards.
Yeah, hi. So,
Paul, do you want to? Yeah.
yeah. So, basically, do you want me to come on? Yeah. So, each of the individual asset management businesses are valued separately. So, you'll see in the top 10 holdings, for example, you'll see the different valuations. You see Equitix about 158 million, LCM 154, et cetera, et cetera. We don't actually value them ourselves. We have a third-party valuation specialist that does that valuation. And that valuation process involves looking at different valuation methodologies, such as market multiples, DCF on future projected cash flows, to arrive at a point valuation, which is then incorporated into the valuation that you see, the 500 million that you talk about. In terms of how we think about that valuation, well, we view that valuation as being fair value for those businesses. As Steve pointed out earlier, those businesses are at different stages of their evolution. So something like LCM, which is at a later stage of its evolution, not yet mature, still growing, but is obviously generating considerable EBITDA on an ongoing basis. I think that's a fairly straightforward business to value. Some of the businesses which are more nascent, such as TCIP or Hawke's Point, might at this stage actually not be profitable, and therefore, arguably their valuation is a bit more subjective, but in the context, their valuation is very, very small. The overall valuation drivers really are the big valuations, significant ones are LCM, Green Oak, Equitix, and Polygon, and they're all generating positive EBITDA. Does that answer your question?
Not really, but I understand. I thought you gave me that answer, but what is your view on the range of valuations of these sorts of companies? That's more of a subjective answer.
Being not our CFO and not an accountant, I feel I'm much more able to answer the question of what you're driving at. I think what Paul's trying to get across is you have to have a very robust process for valuing illiquid assets. And it's not just the TFG Asset Management where we own asset management businesses, but we own other assets that need to be valued independently, and they're maybe private, and there's a process that needs to be gone through. I think to give you some clarity as a sort of owner and developer of these businesses, I feel that in the nascent parts where you're losing money, you're in a J-curve, you're just beginning to gain assets, no one's going to give you any value for them. And in many sense, neither should they, because until you've proven that they're positive cash-generating machines, their only value is in your eyes as the beholder and the startup of the business. But having said that, Steve talked about TCIP. We've been at it for 3 years. We're now on to our second fund, $500–600 million of assets. Of course, it's losing money, but you see the path to it becoming potentially incredibly profitable, and that's what excites us. So to me, it's not about the NAV of that business, because the NAV of that business will become relevant when we get $1 billion, $2 billion, $3 billion, start getting performance fees from the early funds, and people can see the cash generation. I would take Green Oak as another example. When we started the business 2010, it's taken us 7–8 years to have a positive cash year, and that is a business that's gone from zero to being one of the top 10 largest real estate asset management companies in the world. And the reason it takes that long is because you've got to raise money, invest the money, pay your team, sell the assets before you get some performance fees to start getting some positive cash flow. And that takes the best part of 7 years. Now, not surprisingly, during that period, no one's going to give you much value for that business, even though you as an owner or manager feel you're creating a lot of value. Similarly, with Equitix, we talked about what the John Lang acquisition has done. It's brought forward the business plan, and we're raising money for funds, but we can see as owners of the business the impact that has on bringing forward your business plan by a year or more. So that is sort of my qualitative answer. The last piece to sort of put with that, I think I would certainly speak for all of us. There's no way we'd sell any of our asset management businesses for where they're valued in the portfolio currently.
Hi there. Can you talk about how many new asset classes and managers you're looking at the moment, and I suppose through that give us a sense of how TFG Asset Management may grow by adding new businesses over the next couple of years?
Yes, I mean, certainly. Those people who have known us for a while potentially, I think, get frustrated because we can stand here and say these are all the things that we're looking at, and then maybe 6 months later, a year later, 2 years later, in some cases, they don't see much progress. So I guess the answer is, they're twofold. Firstly, from a bottom-up perspective, I think, Steve and I and colleagues probably see, of the order of 100, 150 businesses per year. They vary enormously from people selling off large asset management businesses to someone who's just written a PhD and thinks they have a trading strategy that they can build around it. And we are prepared to see anyone and everyone because even the things you don't do, you generally get a spark of an idea from. So that is the bottom up. And it is impossible to say how many one's going to exercise on because in reality you might do 2 in a month or you might not do one for 10 years. The second way of looking at it is from a top-down perspective. We do have general themes as to areas that we think that there is alpha and there's sustainable alpha. An area that we're not particularly involved in that won't come as a surprise is the private lending world. Globally, I think the banks are being disintermediated by private lenders with private funds across the spectrum, whether it be anything from invoice financing to high yield debt to private lending to small and mid-sized enterprises. So we do have a top-down view. We do see a lot of business from the bottom up. And when they sort of marry, we get the opportunity. And if we find the right people, we can execute. But there are always so many reasons it might go wrong. And we don't have the bandwidth to do 10, 20 deals a year and hope that the few call options survive. That's not really our business model. Our business model is to do a lot of due diligence, and then once we've got something, give it our all to try and help and make it work. So, long-winded answer, but it means it's very, very difficult to stand here and say, we'll be doing 2 more businesses in a year's time. All I can say is we've got half a dozen businesses. We've been at it for the best part of 7, 8 years, so generally it's about 1 a year. I don't know if you want to add, Steve.
If I could add to that for 1 second. The other thing I would say, and it touches on the valuation question, is one of our biggest opportunities is our existing asset managers. If you think a mature asset management business might have a 30 or 40% margin, but the incremental margin on new products or new AUM is actually quite high. And so, one thing that we do spend a lot of time on is thinking about ways of creating or launching new adjacent businesses alongside the ones that we already have. The second piece, as Patty was talking about, as it relates to acquisitions, when I was speaking, I was careful and purposeful to make the point that we approach adding asset managers as investors first, businessmen second. And that's a key differentiation versus other people or businesses in the marketplace that might buy asset managers. For us, because our pool of capital is not organized exclusively to acquire asset managers, unless it's a very, very clear and good deal for us and the team or business we're partnering with, we have the luxury of being able to do other things with the balance sheet capital.
No more questions. Well, with that, if I could say thank you very much. Please join us for drinks. There are a lot of people from the underlying businesses here to ask questions of. And for everyone, there are Tetragon water bottles. Please take one as you leave. Not only will they help you reduce your plastic consumption, but they will be the envy of your colleagues at work. Thank you very much.